First up, we'll define the cash flow statement and understand what it actually is. We also want to answer the question as to why it's important and why, as an investor, you want to know about it. After that, we'll break everything down and look into the real-world example of Tesla. The statement of cash flows, or the cash flow statement, summarizes the amount of cash and cash equivalents entering and leaving a company. It measures how well a company manages its cash position, meaning how well a company generates cash to pay its debt obligations and fund its operating expenses. The cash flow statement includes only inflows and outflows of cash and cash equivalents. It excludes transactions that do not directly affect cash receipts and payments, unlike the balance sheet and income statement. The income statement measures the business's financial performance, and the balance sheet is a snapshot of a business's assets and liabilities on a particular day. If you want to know more about the balance sheet or income statement, please check out our other videos after this. In a world where cash is king, all business stakeholders want to know the cash position of a company. Investors want to understand how a business's operations are running, where the money is coming from, and how it's being spent. Cash flows are really important as they help investors determine if a company is on a solid financial footing. Creditors need to understand the cash flow statement to determine how much cash is available for the company to pay its operating expenses and pay its debts. This is known as liquidity. More formally, there are four main objectives of the cash flow statement. Firstly, it provides information on a firm's liquidity and solvency, including its ability to change cash flows in future circumstances. Secondly, it provides additional information for evaluating changes in assets, liabilities, and equity, as seen in the balance sheet. Thirdly, when we're comparing different firms' operating performance, we can use the cash flow statement to eliminate the effects of different accounting methods. Lastly, we can use the statement to project the amount, timing, and probability of future cash flows. When we think about the cash flow statement, we just want to understand cash, the inflows and outflows of a business. So let's think about an example, Tesla, a name I'm sure everyone is familiar with, but let's think about where its cash comes from. First of all, the business needs to be funded, so Tesla goes out to the capital markets. In the capital market, the business has two options, debt and equity. When a business sells a share, it gives up a portion of its ownership and control, or just a portion of future cash flows. Alternatively, Tesla could issue debt, which means that it promises to pay back a certain amount plus interest, known as coupons if it's a bond. If the business is paying more interest on its debt and dividends to equity holders, then this is an outgoing. But if they're in need of financing, this is a cash inflow. When Tesla sells its cars and other products, it receives revenues from this, the cash flow from operations. When the company sells products or services in excess of its costs and has a positive cash flow, the cash flow from operations is positive. When the cash received from selling their products is not enough to cover the costs of production, the net cash from operations is negative, as it currently is with Tesla. The last main cash flow is from investing. For a growth company like Tesla, it will be actively investing in its infrastructure, like Tesla's new gigafactories. So at the moment, this is another cash outflow. But when these investments become fruitful and begin paying back, they can be represented by larger cash flow from operations or an inflow in the cash from investing. Now we know how these cash flows apply, let's define them formally. Cash flow from operating activities is the cash generated from ongoing regular business activities, such as manufacturing and selling goods or providing a service for a fee. Cash flow from investing activities is the change in cash from investment gains or losses, including money spent on investments in capital assets like property, plant, and equipment. Cash flow from financing activities shows the net flows of cash used to fund the company, including debt, equity, dividends, and interest repayments. This activity in particular shows the investor or creditor how the company manages its capital structure. So now we understand the basic components of a cash flow statement, let's look into Tesla's current cash position. We'll start with what Tesla is actually producing and selling, seen through the cash flow from operating activities. We'll look at this from a basic perspective, so we'll focus on a few key areas. Firstly, the net income at the top of the table. This comes from the income statement, which we discussed in another video. Effectively, Tesla has been making a loss, as its costs have exceeded its revenues in the last few years. If we look at this trend, we'll see that as the company ramps up production and lowers its cost per unit, the net income loss is decreasing and the company is moving towards a profit. After the non-cash items are taken away from the net income, we're left with the net operating cash flow, which is cash received from selling goods minus the cash outflow from producing the goods. As this is currently negative, we know that Tesla is not yet free cash flow positive. Moving on to the cash flows from investing, we see a few key details. First up is the capital expenditure, the costs Tesla incurs from investing in capital goods. Effectively, what we see in this statement is that outflows are the purchase of goods and inflows are the sale of some of their investments. As Tesla is a growth company, the cash from investing is negative, to show that it is investing in itself. In line with the cash flows from operations, the trend shows that the net cash flow loss is trending towards a positive number in the future. Last but not least is the cash flow from financing activities. We can see that Tesla has issued stocks and debt in this section, ending with a positive net cash flow. As Tesla has negative cash flow from operations and investing, it needs to find finance to run these operations, found in the positive inflow of financing. This is important as to see the split between debt and equity for the business, known as the capital structure. Using each of these three sections, we come to the free cash flow, which is what the net cash position of a company is. As we can see, Tesla is currently free cash flow negative, meaning it doesn't have spare cash and needs financing. Note the trend over the last number of years has been trending from larger negative cash flows to almost a positive free cash flow. What do you think of Tesla's cash position? Would you still invest in it even if it has a negative cash flow? Let us know your opinions in the comment section.